everyone, welcome back to Mindful Investing. Today we are diving deep into one of the most tempting ideas in investing, and that's market timing. Does market timing really work? Almost every investor at some point thinks about it. If only I could sell before a major crash and then buy right back at the bottom, I would make a fortune. It sounds like the perfect strategy, but the big question is it realistic? Can it be done consistently, or is it just an illusion? I've studied an excellent research piece from Charles Schwab, and in today's video, I'm going to share their findings with you. They ran the numbers, created real world examples, and even looked at 20 years of data. By the end of this video, you'll see why timing the market rarely works, what happens if you miss just a few of the best days, and which types of investors consistently win in the long run. So, let's get into it. To start, let's define it clearly. Market timing is when investors try to predict when the stock market is about to go up or down and then make buy or sell decisions around those predictions. The idea is simple: sell before the market drops, buy before it rises again. On paper, it sounds like a shortcut to big returns. In reality, it's almost impossible to do it consistently. Even the best professional fund managers who spend all day studying the markets can't reliably call tops and bottoms. Why? Because markets are unpredictable. They move on news, interest rates, earnings, geopolitics, sometimes even random sentiment shifts. No model can perfectly capture that. Now, let's look at why it fails mathematically. Schwab studied the 20 years from 2001 through 2020. If you stayed fully invested in the S&P 500 during that time, your annualized returns was about 7.47%. But if you missed just the 10 best days in the 20-year period, your return dropped all the way down to 3.35%. And if you missed the 20 best days, your return basically collapsed to 0.08%. That's essentially flat. No real growth for 20 years. So, missing just a handful of days out of 5,000 trading days can mean the difference between growing your wealth significantly or having nothing to show for it. And here's the kicker: those best days often come right after the worst days, which means if you panic and sell when the market drops, chances are you'll miss the rebound too. Why do so many investors still try to time the market even when the math is against them? Because of emotions. When markets crash, fear takes over. It feels safe to sell everything and sit in cash. Then, when markets rebound, greed and FOMO kicks in. But by then, prices are already higher, so you end up buying late. This creates a cycle where investors sell low and buy high, the exact opposite of what you are supposed to do. It feels good emotionally because you think you are protecting yourself, but financially, it locks in losses and guarantees you'll underperform. To make this clearer, Schwab created 5 fictional investors and tracked how they would have performed over the same 20-year period. Here they are. The first person, named Peter Perfect, he had the magical ability to invest at the market bottom every single year, almost perfect timing. And the second character is Ashley Action. She didn't worry about timing. As soon as she had money to invest, she put it to work immediately. And the third person is Matthew Monthly. He used dollar cost averaging every month without fail. He invested the same amount. And the fourth person is Rosie Rotten. Poor Rosie always had the worst luck. She invested at the market peak every single year. And the last person is Larry Linger. Larry never felt the timing was right. He kept waiting for the perfect moment to get in. Essentially, he sat in cash. Now, you might assume Peter Perfect, with his flawless timing, would blow everyone else out of the water. But here's the surprising truth: Peter Perfect did the best, yes. But here's what interesting: Ashley Action, who just invested immediately, and Matthew Monthly, who dollar cost average, actually ended up not far behind Peter. Rosie Rotten, who had the worst timing and always bought at the peak, still did significantly better than Larry Linger, who stayed in cash waiting for the perfect entry point. In fact, Rosie, the worst timer, built far more wealth than Larry, the overcautious waiter. And the lesson here is, even if your timing is awful, you're still better off investing than sitting on the sidelines. The real enemy isn't bad timing, it's not being invested at all. Let's take a real example. Imagine you had invested $10,000 in the S&P 500 in January 2001. If you stayed invested until December 2020 through all the ups and downs, dot-com crash, 2008 financial crisis, COVID crash, your money would have grown to about $42,000. But if you tried to time the market and missed just the best 20 days during that 20-year period, you'd be left with around $10,000. That's 20 years gone with basically no growth. That's the price of trying to be too smart with market timing. Now, many of you might be thinking, okay, so what should I do instead? One of the simplest strategies is dollar cost averaging. Here's how it works. You invest a fixed amount at regular intervals like $500 every month, no matter what the market is doing. Sometimes you'll buy when prices are high, sometimes when they are low, but over time it averages out. This approach has two big advantages. Number one, it removes the stress of having to time the market. And number two, it builds consistency and discipline, which are the real keys to compounding wealth. At the end of the day, the stock market is volatile in the short term, but it trends upward in the long term. Since 1928, the S&P 500 has averaged around 10% per year despite wars, recessions, inflation spikes, bubbles, pandemics, you name it. Yes, there are painful drawdowns. Yes, crashes happen, but every single one has eventually been followed by a recovery and new highs. Trying to time each of those events is nearly impossible, but riding them out with a long term view has proven to be one of the most reliable ways to build long term wealth. So, what's the big lesson here? Market timing sounds attractive, but it rarely works. Missing just a few of the best days can destroy decades of returns. Even the worst timer beats the person who never invests. Consistency, whether it's investing immediately like Ashley Action or dollar cost averaging like Matthew Monthly, beats waiting on the sidelines like Larry Linger. As Schwab puts it, the best strategy is to stay invested and let time in the market do the heavy lifting. So, does market timing really work? The data says not for most of us. The better strategy is to invest regularly, stay disciplined, and let compounding do its magic. Now, I want to hear from you. Have you ever tried timing the market? Did it work out for you or did it backfire? Share your experience in the comments below. If you found this video helpful, please give it a like, subscribe to the channel, and join me on this journey to build long term wealth. Thanks for watching, and I'll see you in the next one.